I'd like to call the Senate Finance and Appropriations Committee meeting to order. And if our staff director, April Keyes, will call the roll, please.
Thank you, Madam Chair. Senator Saslaw.
Here.
Senator Normant.
Here.
Senator Hanger.
Here.
Senator Lucas.
Here.
Senator Newman.
Here.
Senator Ruff.
Here.
Senator Vogel.
Here.
Senator Barker.
Here.
Senator Edwards.
Here.
Senator Deeds.
Here.
Senator Locke.
Here.
Senator Peterson.
Here.
Senator Marsden.
Here.
Senator Eben.
Here.
Senator McClellan.
Here.
Madam Chair, you have a quorum.
Thank you. And thank you, everybody, for joining us for this meeting today, both committee members and anybody in the public who is following what's going on with the revenues in Virginia at this point. Before I discuss our agenda, let me go through a few virtual meeting etiquette points. First, please mute your line when you're not speaking. Please introduce or announce yourself when you are asking a question or speaking. I recognize most of your voices, but not necessarily everybody's. And please remember that this meeting is being recorded and it may be possible for the public and or the members to see you. If you're using the video link, you may want to turn the camera off if you need to step away for a minute. Turning to our agenda, first we have Secretary Lane here to update the committee on the August revenue report. This will be followed by Ron Schmitz and Trish Bishop to provide an overview and update on the Virginia retirement system. And we'll conclude with a presentation by Travis Hill from ABC on their COVID response and sales. And now I'll turn it over to the Secretary of Finance, Aubrey Lane. Thank you, Aubrey, for being here.
Oh, thank you, Madam Chair and members of the committee for having me today. What I plan to do is just go through the August numbers, then a little bit about our continuing reforecasting as we work our way through this pandemic, and then talk a little bit about the CARES funding. You all should have received a letter that outlined the major topics in this month's revenue report. I will just mention that August is not a significant month, but the trends that we saw from the last few months continued through August. It'll really be September when we really have a good handle on exactly where things are going, at least in terms of the new revised forecast. And speaking of that, this month's revenue report does have that included in it. The revised forecast is what we'll be using comparing the revenue performance to, in addition to last year. I should mention that obviously this is anticipation of getting a budget. If there is no budget, which I expect that there will be, of course, we would then go back to the previous revenue forecast before the revisions made just this last couple months ago. So just a little bit of background as we're going through this and comparing it to significant data points. So as I said, what I'll do is I'll first start with talking a little bit about some trends, and then to get into the forecast going forward and some, I know some commitments that we have to deal with, and of course an update on the CARES funding. And with that, we can go to the next slide, please. Just a few minutes on some of the indicators. As I mentioned, that the trends that we have been seeing the last few months continued. I'll point out here a couple things: that we're still in a recessionary environment. And that first bullet there really highlights how far down we got. We're down over 30% in economic activity in the second quarter. But we've had a slow and steady recovery from that point. As we mentioned previously, it looks like the low point was sometime in the middle of April towards the 1st of May. And since then, we saw a little bit of spurt at the beginning of economic activity, but it's continued to slow more to a steady pace. On the national level, unemployment has come down to 8.4% in August. As you know, it was well over that to begin with. And I'll also point out the bottom of the page, something that I look at is consumer confidence, and particularly with supply management index, it has risen again for the second month, again, indicating that we're still in a recession, but economic activity is continuing at a very slow but steady pace. Next slide, please. A couple things to highlight here. The tremendous fiscal and monetary stimulus that we showed came from the congressional side of things, the federal side, as I mentioned before, has kept economic activity buoyed as we move forward. The Federal Reserve has said it's going to continue to leave its targeted federal funds rate at near 0%, meaning that interest rates are going to remain low for the foreseeable future. That's helping to underpin, and I'll talk a little bit more about the housing markets across the country and here in Virginia. One point that I did want to make here, though, is that because of all that fiscal and monetary stimulus, obviously that bill has come due. If you look at the national debt for the first time in our history, for the national calendar ends on September 30th, we're going to have about $3.3 trillion in debt just from one fiscal year. That all relates primarily to the response, although it was growing before that, the fiscal response that happened in the last few months. If we continue on this trend, we will be 100% of gross domestic product by the end of next year, which is fairly significant. We'll be in the close to $30 trillion in debt if we continue on this trend. And I'll point out that debt does not include Social Security or Medicaid obligations, nor the guarantees of Fannie Mae and Freddie Mac, the large loans guarantees that are nationally supported. So I mention this only because it could be a determinant of fiscal and monetary policy coming out of Washington over the next few years, depending with the election coming up. And that could have a significant impact on our economy. As you well know, I've mentioned before, we have been buoyed by the fact that we are dependent on the the federal economy, particularly with defense spending, particularly with the number of employees in the federal level. So that policy really makes a difference to us. And I just mentioned this because the debt, I suspect, will have to be dealt with sooner than later, and that could impact us as we look forward here in the Commonwealth. But a little bit about the Virginia economy. Again, just like the nation, our employment continues to rise. Our unemployment level has come down. And just like the nation, if you look at the bottom there, all four components of our index here in Virginia were up for the month. Still very, very depressed, but still moving in the right direction. So just wanted to point out we're trending about what the national economy is doing, although we did not go down as far as the national economy, quite frankly, because of we were buoyed by our reliance on the federal government. So that's just the background a little bit. If we'll go to the next slide, please, and we'll get right into the revenues. As I mentioned, August was a pretty good month. We were slightly behind a year ago. It was basically flat going into that. And as you look at this on a year-to-date basis, because of the good activity we had in the first month, we are running about 11% or 11.6% ahead of our forecast, which was actually indicating a decline of 1.8% to last year. Now, the majority of that relates to over $250 million relates to non-withholding and income tax refunds that happened in this year that really related to last year, and I'll get more into that. But the good news is overall that we are running ahead. If we look at it compared to last year, we're running about $325 million ahead of the prior year in receipts. And again, most of that has to do with non-withholding, which I'll speak about in just a few minutes. Next slide, please. However, our withholding tax collections, even though they were slightly down for the month, have remained pretty steady. We had one less deposit day, which equated to about $40 million in deposits, our revenues. By the way, we'll pick that up in September. So if you put that in, we'd be about flat with the prior year. And the trends that we have seen, the large companies, the tech companies, the defense contractors, the essential businesses are actually holding up well, or they are adding employees. There was a article this morning where Amazon is going to add another 100,000 employees across the country, excuse me. And of course, the Commonwealth will benefit from that. So year to date, we've only decreased 1.9% compared to last year, but I'll point out that we actually project for the year to be up 2.4%. And I'll talk a little bit about that more later, because we do expect this steady increase to continue. Although anecdotally, I'm starting to see large companies like the airlines, like some real estate companies that are laying off people because they're coming to grips with it's not going to be a significant snapback in activity. It's going to be more of a steady increase going up, assuming we don't have a relapse of COVID-19 of any major significance that would cause another shutdown. But it's not going to again be the snapback that many were hoping for. Quite frankly, I would have hoped for too. But it is consistent with what we have done in our projections for the new revenue. So I don't see any need to panic here at all. On the other hand, it indicates that we're trending very close to what our new revised forecast will be, at least in terms of payroll withholdings. Now, by the way, this is 62% of our revenue forecast. So the majority of it comes from this one item. Now, next page, individual non-withholding. Here's really the story. As you can see, through August, we're up $487 million compared with only $135 million roughly last year. And if you combine that with the income tax returns, because they were up a little bit too, and you remember that was because the feds moved their actual tax filing date till July 15th, past our fiscal year. But at least $250 million of this does not relate to the current year. It relates to the prior year. Had we not had those tax changes in the tax due dates, and this money would have hit in last year, just to let you know, we would have made our original budget in last year, which would have not have caused us to reforecast, although we could have called for one knowing we were in there. And now, having said that, I don't think anybody here back in last March thought we would get anywhere near where we would got in receipts. And a lot of this had to do with this non-withholding, as I explained last month, wealth generation that was being generated. Whether or not that continues into this year, we won't know until April. Again, just remember, this all comes due in the fourth quarter. I'll remind the staff and the members here that 33% of our receipts for the year come in our fourth quarter, which are April, May, and June. And of course, a large part of that is driven by the payment of the individual and corporate income taxes during that period. But the good news is we are where we are. We are up this year. And of course, you all know in terms of budgeting, we impose a collar on this revenue source non-withholding. It's the most volatile. And I've had graphs before, which I'll bring back next month, that show, when we have changes of tax policy, this can go wildly one way or the other. This year, it happened to break positively for us. But we can't bank on that as we go into the coming year. And I know there's a lot of talk. There's a disconnect right now, people say, between the stock market, which has remained high, and the general business economic conditions. That tends to be because the stock market is future looking. And if you take that into account, it seems like everybody's banking on the economy picking up fairly steam as we go through the next year. Hopefully that'll be the case. But again, that's not what we're dealing with right now. But to the effect that individuals have wealth generation because of the stock market, this revenue source could be there, but we won't know until the fourth quarter. So when you add it all up, that individual withholding from at least the normal withholding is about on trend, a little bit below, but we've been buoyed by the fact that non-withholding was strong, primarily related to last year. Okay, next slide, please. A significant positive development, I believe, is this sales tax collections. We have, this is about 18%, 18 to 20% of our revenues, and they can continue to be moving in a good direction. Now, we were only up a slight bit for the month, but I'll remind everybody that this year, last year, August was the first month we had the collections from the new Wayfair sales tax. So we were coming off very strong collections in August last year, being up 15, 20%. And yet we still did that for the coming year. So this revenue source is performing well, and all of it, all the increase comes from the internet sales or e-commerce. Traditional retailers are significantly down, and this has been a shift to online. Thank goodness we did that, those revenue changes last year regarding to internet sales, or we would be significantly impacted here. As I mentioned before, it shows no trend of this stopping. We're continuing each month to get new people signing up as they move away from traditional retailing into internet retailing. And therefore, we may be a little bit conservative in our forecast here. And I'll talk a little bit that later, because it looks like the trends we were expecting to be down almost 10%. You can see in the forecast for the year. And if these trends continue, we'll probably do a little better than that. And I'll speak to that a little bit as we go forward here. But good news is here, sales tax collections continue to perform well. I'll also mention, we know a lot of this spending was buoyed by the fiscal stimulus put in the economy, direct transfer payments to individuals, whether it was through unemployment or direct other checks. As we now know, it doesn't appear that stimulus funds are going to be continued at any time soon. So we got to watch it here, because I know that helped buoy this, because actually credit card defaults went way down during this period because of those additional monies coming in. So we'll have to watch this going forward, but at least we are positioned well because of the Wayfair legislation to take advantage of the shift that's happening to internet sales. So next page, please. Net corporate income tax collections, although they were up, this is not a significant month. These swing wildly. We'll know more when we get to the end of September if there's going to be, for instance, if there's going to be any ask for rebates from the previous year. But it is to note here, so far they have remained good. One bright spot that I think is going to continue, and I mentioned in my opening remarks, and that is recordation taxes. Housing market and refinancings remain very strong. In fact, there was an article yesterday about the Richmond market being up over 4% for the current year. And all-time low now, a 30-year fixed-rate mortgage is now down to 2.86%. A 15-year mortgage would be under 2.4%. Those are unheard of, and that has helped people in terms of not only their debts, but refinancings. If you talk to a lot of the financial institutions, they will tell you they have significant backlogs in refinancings going forward. So I expect this to continue, and it appears that the housing market is being buoyed by low interest rates. So we should be a little bit more positive to that. Not a significant source, but again, for the month, we collected almost over $50 million here versus only $41 million last year. So fairly significant, at least in terms of this revenue source. The insurance premiums tax, as you all know, the first $181.4 million goes to transportation. I mentioned in my previous reports, we were concerned about insurance rebates, because if you watch TV, Geico and others are giving rebates to their customers because they couldn't drive or they weren't out and about. Although that has not showed up yet. We're tracking about what we did last year in terms of insurance premiums going to the transportation trust fund. So they may show up, but not yet going forward. So nothing to really report there. So next page. So when you add all this up, and I know these graphs they're in percentage terms, and when you look at the non-withholding, it sort of things out of kilter. But the 2 points to make here is right now through August, we are $376 million ahead of our interim forecast. And again, that was a forecast of being down about 1.8%. So far, we're up. And the majority of that is related to non-withholding. You can look at the percentages and see how crazy they look at 266% up variance. And as I said, in dollar terms, that's over $250 million. in terms of really don't relate to this year, but going in last year. But as I said here today, that money is in the bank, meaning that if we met our budget going forward for the rest of the year, then we would be up $376 million to the budget. And I'll talk a little bit about that in a few minutes. But if you look at this, I'll call your attention to the right side of the graph. Our estimate shows that we could be down 3.8% for the rest of the year. And if you look at last year, we were up 1.3%. So I don't see anything right now that would cause me to say that our estimate, our revised forecast would be, we won't attain that. Again, we'll find out a lot more in September. But again, right now, as a result of those monies transferring from the previous year into this year for non-withholding, we are substantially up for the first couple of months. Now, if you go to the next page, this is comparing us to the original budget, Chapter 1289, where we would have been if we hadn't reforecasted. And as you can see, to make that budget, we are still up a couple $100 million ahead of the original forecast. But again, all that relates to non-withholding. Had we taken that out, we would obviously be down. And of course, this would show to make the original forecast, we would have to be up 3.3% for the year. And again, last year we were only up 1.3%. So this again indicates to me that the revised forecast is pretty realistic based on our activity and at least the receipts for the first couple of months. Next page. This brings me to our next, where we go from here. Obviously, September will be a key month because we get estimated payments from individuals, corporations, and insurance companies. So this is the first significant month. We'll have well over, hopefully, a couple $1 billion in receipts or more that will tell us where we really stand. It will also be the last data point that we can include in the revenue models as we look at a reforecast, sometime that we will do in October and November in preparation for the regular session that will start next year. And of course, the sales tax for August will complete the summer tourism season. So, so far we haven't seen an impact to that, but we'll know for sure because last year was a very good summer tourism season, and we're going up against that. August sales were paid in September. So we'll see how that compares as we go to into the next month. Next page, please. Which leads us to right into the revenue reforecasting schedule, what we just did a few months ago. We will do again. On November 4th, we'll have the Joint Advisory Board of Economists. We'll come in and go through where we stand through the end of October. Then on November 23rd, right before Thanksgiving, many of you will be back here or either on TV or someplace with us for the Advisory Council on Revenue Estimates, where you can weigh in along with our business advisors around the Commonwealth. And then on December 16th, the governor will present the revised forecast, if any. And I say that with if any because I have a couple comments on that as we go to the next screen. But that will be done on December the 16th as we move forward. So to give everybody an update of where we're going. Now, before we go to the next screen, I did want, and you can leave it up there, it's fine, but I did want to point out a couple things about the revised forecast. If you look, I'll go back to withholding, 62% of our revenues. Through July and August, we collected a little over $2 billion. To meet our budget for the remainder of the year, we need to collect $11.6 billion, roughly. Last year, for this same period, we only collected $11.3 billion. So in other words, the revised forecast, we would have to do better than we did last year for the next 10 months. Now, of course, we knew we were off a little bit in the last quarter of last year, but the point is that it goes back to we're expecting to increase 2.4% for the year in this revenue source, and we haven't seen that yet. Actually, we're down as compared to that. So if this trends were to hold, that would put us $360 million below our budget in this forecast. So again, 62% of our revenues it looks like to me we're trending pretty close to the revised forecast. We would have to have a substantial uptick to meet this going forward. And the same is true on the reverse for sales taxes, though. For the first 2 months of this year, we collected $521 million. The last 10 months of last year, we collected $3.2 billion. And our budget only implies that we're going to collect $2.8 billion for this year, the revised forecast, meaning we could be $400 million short in this revenue source, or short meaning we would have a positive. So when you take the two together, it looks like they about offset. And I say that to point out that I don't expect this new revenue forecast to differ significantly from the current one. Now, that could all change in September. Certainly that could all change if there was a vaccine and there was a tremendous uptick. But based on where we are, it looks like the revised forecast is pretty close on our two major revenue sources. They offset each other. 80% of our revenue is between withholding and sales taxes. So I just wanted to point that out, not trying to be negative nor overly optimistic, but realistic. Remember, we don't have the negative impact that many thought that was going to happen, more so than we do. But I don't see cause to say we're going to have hundreds of millions of dollars more revenue, at least how we've trended through the first couple of months. And again, that is all subject to going through the new reforecast, but just looking at some of the data endpoints to where we stand today. Now, over and above, even if we do have some revenue forecast increases, we know we've got some issues that we're going to have to deal with. And of course, top of this is COVID-19. That still remains something to deal with. I'll just mention the vaccination cost. All the federal dollars that we have gotten, significantly all of them, expire on December 31st without a continuing action. I don't think the vaccine is going to be available widespread until after the first of the next year. Therefore, meaning at the current time, we don't have federal dollars we can use to get us prepared and to use to inoculate our citizens. So that's just one thing of COVID-19, that I know of, that right now there's not a funding source that takes us in the next year. Potentially congressional action could help, but right now that's not out there. Of course, we know we have mandatory Medicaid forecasts that we have to update going forward that we'll take into account. Maybe there's a savings, maybe not, depending on utilization, but that is still standing out there. I put up here federal actions, not just the normal, but we know all the CARES funds that we're spending will be audited. So hopefully we'll find out all those have been used appropriately, and I'll talk about that in a few minutes. But that is still something out there that we have to consider. And of course, transportation funding, while not a general revenue fund, we know it's going to be off. There's some language in the budget that could help with that going forward in terms of projects. But if you look at August report, and I'll report on this more so in September, transportation funding was still down, more so than general funds, because of the lack of mobility and usage around the Commonwealth in terms of that. The last thing I'll mention here is offsetting some of this. We do have reserves. We have used about $900 million in reserve monies that were targeted to go into reserves to help sustain us through where we are today, which has given us some beginning balances that are available to help us going forward, and also has maintained us so that we haven't had to cut core funding from the previous year. It's not that we'd like to spend more had these revenues been up, but unlike many states and unlike previous recessions, we have not had cutbacks into actual spending from the previous year. And I think that's worth saying here. A lot of that was been buoyed by the $900 million that we did not put in reserves that were targeted. We still have $1.1 billion left in reserves. But again, there is a lot of unknown risk related to COVID that we're dealing with. And so they're available for us in the future should we have another downturn, or quite frankly, there is no guarantee. We hope to have a vaccination but there is no guarantee that it's going to be widely accepted or efficient, at least until we know that. So just want to give a little bit of input over and above the revenue, some things to keep in mind, which leads me to the next page. And my final report is on the CARES Act funding. Just a couple things to refresh the members on. We received roughly $3.3 billion in direct state and locality. I say locality because $200 million went directly to Fairfax and $3.1 million to the state, of which we have given almost 50% of that to localities across the Commonwealth. But that is only a part of a lot of the monies that came here. There were close to $20 billion between the PP payroll protection program, other revenue streams, direct transfer payments to individuals that came into the Commonwealth that I reported on in previous months, that again has helped sustain us. And as we sit here today, that is no longer the case. Nothing in congressional action is indicating that that is going to continue to move forward, including the guidelines regarding flexibility. They've continued to change, but remember, we were hoping we were going to get some flexibility, that maybe some of these monies could be used for general revenue purposes. That has not been the case. As a matter of fact, I know we hear a lot coming out of Washington and the White House about cutting red tape. Well, that wasn't their mantra when we were dealing with this, because they put significant restrictions on these monies in a very short period of time. And that has been part of the reason of making sure we're meeting all those obligations. As you remember on the previous slide, I mentioned it's going to be audited. And the last thing we want is to make sure we don't have to give any of this money back from an audit because it was used unwisely. And as I mentioned, it doesn't appear we're going to get any of that flexibility going forward. So next page, I just want to remind people of where we are. Before we get into the details, this is an update of the report I've given you last month. And let me point out that because of the restrictions and because of the usage, this pandemic has pointed out many challenges that we were already facing. We know, for instance, in architecture, we had an issue with our unemployment systems. This is nothing new. We hadn't invested in those in many years, but it put tremendous pressure on that to get those monies out. We had to deal with that. I'll also say that had to do with PPE, that there was no guidelines, there was no national system set up. So getting personal protection equipment, as you recall, took us a couple months to get that supply chain in place because there was no national strategy in doing that. It has certainly highlighted where we've had ongoing organizational structures. Again, these things aren't new, but where we've had leadership or organizational issues in the past, they've been exaggerated. I first had to deal with this when I was Secretary of Transportation. Many of you helped me work through the old funding formula. But remember, for 2 years to get that right, we didn't allocate monies to make sure we got it right. Yet we were expected here to take all these systems and make sure this additional impact, they were all good and get this money out. And of course, as I mentioned before, that was exaggerated and exacerbated by the changing guidelines we kept getting from Congress. So I just bring that out, not as to make any excuses, but to point out the difficulties as we've gone through in deploying these monies based on the guidelines going forward. The details below give you the top part you've seen before. I'll just highlight the fact that so much that went to the localities, almost over $1.5 billion when you collude directly to Fairfax. And I'll point out, we'll be giving an update later to your staff. We've gotten surveys back from the localities, and they are dealing with the same issues we are. But I will point out that many of them expect to use their largest source of these monies has gone to public health and public safety for employees just like us, K through 12 spending. And I would point out much of that is coming in the last quarter, as they knew had to deal with. Certainly the PPE acquisition going forward. So they're dealing with some of the same issues we are. But the good news, by getting so much to the localities, they were able to pinpoint it exactly where they needed it. instead of an overall scheme to give everybody money based on a certain criteria, they were used to pinpoint. I think that is worth noting as a very efficient use of these dollars. Now, as we go through, as I say, down to about the last third of the page, those requests down below are now under review. And I should point out that our deputies here in Senate and Finance, Joe Flores and June Jennings, have briefed your staff and the House staff on PPE, housing, utilities assistance program, testing and contract tracing, and K through 12. So we will continue to update your staff and work with them as we move through these. As you can see down below, the ones that we assume will be approved and gone very quickly are those ones under review. They have actually been approved by Finance and are now awaiting the final approval, working with the governor, having gone through all this. Now, I should point out, having said that, for instance, the final one, testing and contact tracing, we worked for several months with Accenture and Department of Health to make sure that was a coordinated plan with what we were doing at the localities and going forward. In addition to these on here, because I know you still see about $1.1 billion that's unspent, or it's not unspent, that we haven't officially allocated. I will note that K through 12, we anticipate at least $200 million. The guidelines changed there that helped us, and we can give $500 per pupil now without having to have documentation of direct impacts to COVID. That just came out a couple of weeks ago. So that'll free us up to move those monies forward. But certainly the addiction treatment, behavioral health, broadband, we know we have a big issue with higher ed that we're working through, hazard pay for frontline workers, whether they be in the food service or in health, health. Certainly other issues here in the Commonwealth. We had anticipated an additional $150 million for mortgage and rental assistance that may or may not be needed as we work through that program. But I want to end on this, Madam Chair, is that we don't intend to give one nickel back to the federal authorities. And where we can use this money, if it is not, and I expect it will all be spent, is the Unemployment Insurance Trust Fund. So that to the extent that can be quickly deployed, which we know that if you had a presentation that indicated almost $750 million deficit is anticipated in that through this year. So we do have a use for these monies, and I don't want that to be the default. I'm just letting the committee know that there are backup plans to make sure none of this money will be returned to the federal government and will be put to good usage. And so with that, Madam Chair, that's my report. And I know I've gone a little bit longer, but certainly we're happy to answer any questions if there are any.
Thank you, Aubrey. This was very thorough and clear, understandable. So thank you very much. Are there any questions for the Secretary?
Madam Chair?
Yes, Senator Marsden.
Thank you very much. Secretary Lane, the Christmas season is coming up, and that's always been a tremendous revenue generator. Do you have any, has there been any analysis of what Christmas is going to be like under COVID and what consumer behavior is likely to be like given some of the restrictions we have on gathering in large crowds? And although the online sales seem encouraging, has there been any look at what that might look like this year?
Yes, Senator Marks, a couple of leading indicators we look at, and I became aware of this when I was former Secretary of Transportation, and that is shipments coming through the Port of Virginia coming to retailers. And while they are picking up, they are not at what they were in previous years. So we're expecting, if you were looking at that, at least retailers are not expecting to move the amount of merchandise so far that they have in previous years. Having said that, also, Senator, we do know that these large online providers like Amazon and others are adding personnel. So we do expect a significant increase in online sales. Hopefully, The distribution system for those we've heard about the post office and other carriers. I just saw that the private carriers are adding personnel also, expecting to pick up the slack from the post office if there is any. But right now, Senator Marsden, I would just say it is uncertain, but I don't know anybody that is predicting a significant increase in Christmas selling. Hopefully it won't be a negative, but right now, those are just a couple things that we're looking at, and it indicates that there will be a Christmas season, but it doesn't appear as robust as we've seen in the past, at least as we sit right here today.
Thank you.
Is there another question?
Madam Chair?
Senator Barker.
Yes, Secretary Lane, this is Senator Barker. When you come next month, one of the things that might be helpful to us is to understand for each of the quarters for this fiscal year, what we would need to do to be able to meet the targets and how we would be able to do that. And I'm saying that partly because clearly we don't expect that we will have, a dive in the fourth quarter on things like withholding and sales tax revenues that we had in 2020. And so since hopefully we'll be on a smoother path and be able to sort of maintain what we have the first 3 quarters into the fourth quarter and deal with whatever the non-withholding issues are, would be helpful to sort of understand how that would play out.
Yes, sir. Senator Barker, be happy to do that. And you are right about the fourth quarter, although I would say we didn't have nearly the dip we were expecting. So the fourth quarter was actually pretty good, but nonetheless, you are right. So I will make sure I have that in there, and I'll break that down by quarter for my next presentation. Yes, sir.
All right, thank you.
Is there another question?
Janet Saslaw. We see all these reports that, this is ahead of this item is ahead of last year, that item's ahead. Are you still projecting overall, when all is said and done, about a $2.5 billion shortfall from what we projected when we left Richmond last March for 21-22?
Yes, sir. Yes, sir. As we sit here today, and I've talked with our economists, what we know through the day, we are trending very close to that. Now, that could change if we got economic activity. But, Senator, I don't think we're going to see much of this change until there is an actual vaccine. I believe we've been saying from the very beginning that it's not going to be a government-led recovery. If that were the case, based on some of the things our president was saying, where our economy would be jumping through the roof. It's going to be based on consumer confidence when they feel safe to go back into some of these establishments. And no government is going to tell them that. That's going to be a behavior that they'll feel good about once there's a vaccine and then their own personal decisions. And that's been pretty clear from the very beginning. And I think that's still going to take some time to work out in that regard. So this is not going to be something that we can make consumers do. It is a safety measure. And right now, Senator, our revised forecast within $100 million one way or the other, because nobody is that accurate. It looks like to me it's pretty realistic. But again, if we were to get a vaccine that could be widely accepted and done, I would expect the economic activity to kick up pretty quickly. But we don't have that data now.
Thank you.
Is there further question? Okay, well, thank you, Mr. Secretary. Not the good news I was hoping for, but a dose of reality, I suppose.
Thank you, Madam Chair, and look forward to we'll have some more information next month. Thank you very much.
Thank you. Okay, now I want to welcome Ron Schmitz and Trish Bishop from the Virginia Retirement System. Welcome to you both.
Thank you, Madam Chair. I guess I have the privilege of kicking this off. Members of the committee, I appreciate the opportunity to present to you today. For those of you who I have not met, my name is Ron Schmitz, the Chief Investment Officer for Virginia Retirement System. I'll provide an overview of investment activity and then turn it over to Trish to do the report on the administration and member services side of the shop. We can jump to page 4 if you would. So here we see the growth of the fund over the last 20 years. This is a slide I use a lot for these kind of presentations, use it annually for JLARC. You can see that there's not a steady year-over-year progression upwards as recessions and bear markets impact fund returns, which in turn impacts the balances of the assets under management, balances of the total fund in aggregate. Such recessions can be relatively gentle, as in 2001, 2003, as you can see here, or they can be more pronounced, as in 2008. And in fact, we had a downturn and a bounce back that makes 2020 actually look relatively mild, even though I can tell you back in March it didn't feel mild at all. Next slide, please. These are the fiscal year returns since 1990, so going back 30 years. A couple of things: the light green line across the horizontal line between that 5 and 10% levels is the assumed rate of return. It was 8% from 1990 to 2005, dropped 0.5% in 2005 through 2010, dropped to 7 in 2010, and then last year in 2019, the board dropped the assumed rate of return to 6.75 that we're currently using, and that factors into the contribution rates. In addition, this slide shows you the green bars that of annual returns in each of the fiscal years shown. And you can see that the return plots fall above and below the line, just giving you a sense of the annual volatility in a pension portfolio that's invested for long-term gains at reasonable risk levels. The thing I would note is that while there's a lot of volatility both above and below the assumed rate of return, if you look at all of those plots, annual plots, and average them, you come pretty close to that assumed rate of return line. The fiscal year return, just to point out, in 2020 was 1.4%, obviously well below the assumed rate of return, as a few other recessionary periods have been in the past. We'll talk about this further in a few minutes, but I will say that the return, while below the assumed rate, was above the board's benchmark. So for that, we're grateful. Next slide, please. This pie chart just shows the asset allocation, shows how the fund was positioned at June 30. Traditional public strategies like stocks and bonds are the largest asset classes. Here you can see in the various shades of green. The less traditional asset classes such as real estate and private equity have significant weights, but are not as dominant in the portfolio on an individual basis. Compared to our peers, a couple of notations. VRS does tend to be a little bit more international in its focus than some of our peers, which are more US-centric. We do have a bit more exposure to private strategies, private equity, real assets, and credit than do some of our peers. Next slide, please. The positions shown in the previous slide are a bit different from the long-term board targets, but also represent a change from the historical asset allocation targets that the board had, say, 8 to 10 years ago. The board's long-term target shifted pretty significantly in 2013 and has been reaffirmed by very detailed studies twice since then, including last year in 2019. We do target more private equity and less traditional stocks and bonds than what we used to back in the 2010 period. So I wanted to give you kind of a sense of what to expect, or we'll try to make this statistics without it being mind-numbingly boring. In any given year, we would expect the return to float around the 6.75% assumed rate. In 2/3 of the time for a 1-year period, we would expect the return to be 6.75 plus or minus the 10.4% expected volatility. 90% of the time, we would expect the return to be the assumed rate, 6.75 plus or minus about 21%. What that means is that any given year, 10% of the time, you'll see returns above 27% or less than negative 14%. That's very normal, very typical for a pension portfolio invested for the long term and not immunized exactly to the liabilities, which is something that, not to get off subject, but you can really only do when you're 100% funded. Next slide, please. Just to give a sense of how those annual volatilities change as you look over longer and longer time periods, this slide shows the VRS returns for annualized periods from 1 to 25 years. Note that there's some variation in the return even over the longer term, but that the returns do tend to float around that assumed rate of return once you look at longer term periods, say 5 years or longer. In fact, from 5 to 25 years, the rate of return, annualized rate of return fluctuated from 5.5 to 8.1%, which is relatively tight, pretty tight to the assumed rate of return that we had at the time. Of equal importance, I think, is that the portfolio results exceed those of the benchmark over all time periods, which means that decisions by the staff and by the board have reduced or have outperformed the performance of a theoretical passive portfolio that could have been implemented by the board instead of the active management that we use. And secondly, this excess return of about 0.5% over 25 years has worked to reduce by 5 to 10% the cost of the overall pension program because the return is higher than the assumed rate, which has the impact of reducing the cost of the program overall. Next slide, please. Just a couple of relative comparison charts for those that are interested. I know sometimes it's interesting to know what, if not what your neighboring states are doing, at least what other states and so forth are doing. This is a plot of returns on the vertical axis and risk defined as volatility on the horizontal axis for VRS and our peer public funds. It's provided by an outfit called Trust Universe Comparison Service, which is an independent third party that gathers this information from custodian banks. This slide shows that VRS generates a return above the crosshairs and at a risk level that's below average, which means that the portfolio is actually very efficient. A couple of things I would note, the annualized return over the 5 years shown here is a little bit lower than the 6.75 assumed rate. We saw that in an earlier slide. But the main thing I wanted to point out is if you look down from the circle down to the risk level, you see that over 5 years, the risk has been about 7%, significantly lower than the annual risk of 10% that I talked about earlier. So what that means is over time, we expect to get closer and closer to that assumed rate of return. But over time, as you go from periods longer than 1 year, looking at 5 years, which is what's used in setting contribution rates, you tend to see that volatility, that annualized volatility dampens pretty significantly. In this case, about 30% from the annualized expected. Next slide, please. This is the last slide, and it's another third-party assessment. It's information gathered from Cost Effectiveness Measurement Service, which is a third-party organization based in Canada. They gather information from investment portfolios all over the world. The plot here is U.S. public funds and VRS. VRS is shown by the golden triangle there, or with the arrow in the circle. You can see that we're in the top left quadrant, which means we're generating better return at lower cost than our peers. So we're pleased with those results. We've plotted those kind of numbers pretty consistently over the last 5-6 years that we started working with CEM to benchmark our data. And at this point, I guess that concludes my planned remarks. I'm happy to take any questions if there are any.
Janet Saslaw.
Senator Sassel.
Yeah, we've always been told, at least up to a few years ago, that you don't want your percentage of retirement assets to fall below 81%. What percent, given what we now have, is funded of the retirement?
I think Trish will actually cover that in her slides, but depending on whether you look at the state or if you look at the teachers, it's in that kind of mid-70s range. So we're very, very much able to operate at that level. And again, Trish can speak to this more. 80% is, though, deemed kind of a universal benchmark that indicates
right.
You'd like to be.
Thank you.
Any other question? Okay, then Trish.
Well, thanks, Ron. Thank you, Madam Chairman and members of the committee for the opportunity to share a little bit more about VRS with you today. Next slide, please. In fiscal year 2020, VRS paid out about $5.3 billion in benefits to our retirees. And the good news is that about 86% of those dollars remain in Virginia. And so these payments get circulated back into the state and local economies, which is good news for all of us. Next slide, please. This slide shows you the total membership of VRS. We serve about 742,000 active members, retirees, and beneficiaries. The teachers are our largest group, and the hybrid plan is now our plan for new members, with the exception of those folks who are in hazardous duty positions in local governments, as well as those who are in sports and valors. And those folks who are in enhanced hazardous duty positions are covered by Plan 2. Active membership in the hybrid will soon eclipse our Plan 1 membership. Next slide, please. I think, as you know, the hybrid plan includes both a defined benefit and defined contribution component or structure, and it employs a shared risk model between the employer and the employee. In contrast, Plan 1, which is a pure defined benefit plan, the employer bears all of the risk for their members. To illustrate how the hybrid reduces risk, for example, it reduces longevity risk by providing a lower defined benefit plan benefit, and a portion of the DC benefit has no future risk associated with it because it does go into that defined contribution plan. The only risk about it is making sure those contributions are paid. The plan also reduces investment risk by about a third, because a third of that benefit is in the defined contribution component of the plan. Additionally, the hybrid plan provides portability, which is popular with employees, and that's because of that defined contribution component of the plan. Finally, the hybrid plan's different age, service, COLA, and multiplier provisions serve to lower the future costs of the plan over time, and those savings are blended into the overall contribution rate over time. Next slide, please. So this gets to Senator Saslaw's question. This is the state employee plan, and this deals with funded status. Funded status is the ratio of assets compared to the plan's projected benefit obligations. And so, as you can see here, we've estimated fiscal year 2020's funded status to be 71.6%. We will do our actuarial evaluation for the state and teacher plans in October, and so this may vary slightly, but we're estimating that we'll take a dip from 75.2 to 71.6% for the state plan. And that dip is primarily attributed to market returns. And this particular graphic is using a market value of returns versus an actuarial value. So the next slide, please. There is a similar pattern for funded status for the teacher plan, and it will also have a dip from FY19, where it was 74.1% funded. We're estimating that it'll be about 70.9% funded for FY 2020. And again, market conditions were the primary driver of that dip. Next slide, please. So this slide shows you the employer contribution rates that you approved for fiscal year 21 and 22 during the regular session. The contribution rates from 2020 are also included on this slide just for your reference to see how they compare. As a reminder, contribution rates for 21 and 22 were established using the June 30th, 2019 actuarial valuation. So there's always a lag between when the valuation is done and then those rates are set and then when they go into effect. And so those 21 and 22 contribution rates are not impacted by the market conditions that we saw this last fiscal year. So with the exception of the judges plan, you'll note that rates generally increased from fiscal year 20 to fiscal year 21-22. And that was largely due, instead of to market conditions, was to the lowering of the plan discount rate, as Ron mentioned, from 7% to 6.75%. And that's our long-term assumed rate of return that we use. The last 3 rows of this slide show the estimated employer contributions in dollar terms, what they represent. And so the increase over from 20 to 21 was about $178 million, with about $74 million of which was in general funds. The next slide, please. So as part of our stress testing efforts at VRS, we examine a range of potential risks to the fund, both economic and demographic, to assess impacts on funded status as well as contributions. The next few slides are derived from our stress testing and sensitivity analysis efforts and provide some insights into the future rates and funded status. So next slide, please. It's a little tough to see on this graph, but these are recovery scenarios that we developed back in April during the initial outbreak of COVID-19, and they were included in our stress testing report, which is a legislative document. So while the markets recovered from the lows seen in March, we still expect, as Ron mentioned and Secretary Lane also alluded to, that there may be some challenges ahead, and certainly uncertainty remains. But as shown on the left side of the bottom of this slide is illustrating what's considered a V-shaped recovery. It's a little bit steeper and faster return to prior pandemic returns. And it would yield a cumulative return over the next 5 years of about 5.31%, which is lower than our long-term expected rate of return. In the bottom right, you'll see what's considered a U-shaped recovery, which is a slower and more gradual recovery pattern. And that would yield about a 2.17 return over the next 5 years cumulatively. But at the present, there's analysts are still unsure what pattern it will be, but it's somewhere in between the two models, which looks a little bit more like a Nike swoosh. And so it would be a little less deep and a little less steep and more gradual upward slope that would ultimately result in about a 3.75 cumulative return. Again, there's a lot of uncertainty and we're not exactly sure what the future will hold, but so we'll continue to model these impacts. So next slide, please. So to that end, and trying to look forward, we've modeled future contribution rates on various future possible return scenarios for FY21, ranging from 0% or flat to 6.75, which is our assumed rate of return. So keep in mind that the valuation performed as of June 30th, 21 will be used to set those rates for 23 and 24. That's the lag I mentioned earlier. So the table provides estimated contribution rates for 23 and 24 based on those various scenarios, and also provides the funded status. So as an example, if market returns for the fund for 21 were to return to 0, the funded status for the state plan on an actuarial value of assets would go to about 73.39%. And employer rates would increase to about 15.31% from the current 14.46. And just to give you the magnitude of this, about a 1% increase in state plan contributions requires approximately $43.8 million in additional funding across all funding sources, roughly split 40-60 between general fund and non-general fund. Next slide, please. So this is a little bit of, I guess, good news on a sliding scale. Teacher rates for 23 and 24 are expected to be a bit lower than the current rate, which is 16.62. And the reason for this is because the 10-year deferred contributions that you've been paying off over time for the teacher plan will be paid off by the time that valuation is conducted. And so that payment lowers the employer contribution rate by about 0.7%. And so while all the rates are lower than what's currently being paid, the expected drop, which was about 0.7%, will be muted somewhat by the impacts of market returns. And so to illustrate, if market returns for FY 2021 were to return to 0%, which is that first line in the table, the employer rates for 23 and 24 would be an estimated 16.53%. And that would be a reduction of about 0.09% instead of what we had originally anticipated, which would have been a reduction of about 0.7%. And then again, keep in mind that the valuation there's a good bit of time between now and June 30th, 2021. Before these rates will be reviewed. And then, of course, that actuarial valuation will be conducted next fall. Next slide, please. So just looking forward again, an experience study will be conducted in the spring, and that's where we look at our assumptions compared to our actual experience. And first, the new public sector mortality tables are now being used, and they may cause a slight increase in liabilities in certain employer groups because of longevity increases. Also, we use a funding method that determines contribution rates based on a percentage of covered payroll. And so what this means is that if employer revenues cause payroll growth to decrease due to layoffs, furloughs, hiring freezes, we would have to see an increase in the percent of payroll in order to collect the necessary funds required to fund those contribution rates. As always, we are incredibly gratified by your continued commitment to funding the plans at the actuarially determined board certified rates. We know, particularly in this environment, that that's a heavy lift, but this commitment has been positively viewed and including by those in the rating agencies. Next slide, please. So lastly, I'll share a few comments regarding customer service. Next slide, please. We really take seriously our commitment to serving the Commonwealth's public servants. And this slide is from a benchmarking study conducted by Cost-Effective Measurement that Ron referred to earlier. And it compares VRS to our public pension plan peers. And we are the blue box with the yellow arrow pointing to it. And this yellow arrow indicates we can be found in what's considered the favorable quadrant, where we provide a high level of service at a lower cost compared to our US peers. So next slide, please. So we are incredibly honored to serve the Commonwealth's public servants who are completely dedicated to serving others within our community. And we're committed to helping our members plan for tomorrow today. I really greatly appreciate your time this morning and thank you for the opportunity, and I'd be happy to answer any questions.
Thank you, Trish. Are there questions for her? I don't know. Either it was so wonderful we understood it all, or it was above our heads. But in any event, thank you so much, both Trish and Ron, for your presentations.
Happy to help. If there are questions later, we're happy to take them. Thank you.
Pleasure. Thank you.
Next, we're going to hear from Travis Hill from ABC.
Good morning, Madam Chair. Can you hear me and can you see my screen?
Yes to both.
All right. Good morning. It's a pleasure to be here with you this morning in a virtual setting. Wanted to provide an update on both our ABC response to the COVID-19 outbreak as well as our sales overview. And so I know you all handled the numbers, but you couldn't have the numbers without the incredible work of our employees. And so wanted to bring you up to speed on some of the things we've done as an organization in that regard. So really a multidimensional response on our part. We've got a central office of about 400 employees. We went remote middle of March, much like the rest of the state. We do have folks on site processing licenses as well as taking payments and then operating a warehouse with over 100 employees there. Also, an enforcement division that had to really pivot around a lot of closures of licensees and how to assist these businesses to continue to operate, and then our own retail operation and making sure that our stores remained open and safe for shoppers, and then operating that warehouse as well. So touching on enforcement first, with the executive orders 51 declaring a state of emergency, gave us some additional authority to adjust our regulations to assist businesses. We ended up developing 16 topics beginning in March that created guidance for our licensees to understand what they might be able to do in this new environment. It was based on phone calls with stakeholders, receiving questions, inquiries, and then also working with Secretary of Public Safety and the Northam administration on addressing those issues. Some of the things that we touched on, simple things like making sure folks didn't have to take a clipboard and give a physical signature as they were receiving a delivery. Also opened up ability for manufacturers to make hand sanitizer as producers shifted from developing product of a drinkable nature to one of a cleaning nature. Also looked at allowing on-premise licensees to sell beer and wine for off-premise consumption, which really opened it up for a number of our other licensees, over 6,000 there. Another over 6,000 licensees were allowed to deliver or curbside pickup off-premise wine and beer without having to go through that licensing process or get that additional permit, to try to be as reactive as possible. Also, as the state began to open back up in its phases, we were able to create a process that accelerated the approval of outdoor dining areas, since folks were not able to dine indoors. Licensees were anxious to get back into business, and so we were able to process 600 approvals very quickly so that folks could serve outdoors. And then also we allowed for the direct shipment of spirits by our distillery stores, and we have 40 distilleries engaged in that practice, and they've seen a benefit to their sales since their tasting rooms were closed. There were some things that were beyond our ability with the executive order, and that's when we worked with Governor Northam on Executive Directive 10. Two of the big items there that provided relief to the industry, one was a deferred license renewal program, where we deferred for 90 days licenses that were coming up for renewal in March, April, May, and June. And this really had the effect of not forcing a business to decide whether or not they were going to spend money to renew a license or continue to employ folks in their dining facilities. And so we were able to push that back, where approximately 9,000 licensees were eligible for that deferral. We also had a cocktails to go measure that I think has been very popular with licensees and with customers, where we allowed distilleries, limited distilleries, and mixed beverage restaurants to have cocktails to go. This is where distillery licensees could do a maximum of 2 mixed drinks per delivery, and mixed beverage restaurants could do up to 4 takeouts for at least one meal that was ordered. We did want to impose certain restrictions on that in terms of ordering food, making sure the container was sealed, doing things that would still enhance public safety, but allow licensees to engage in a high margin portion of their business and selling mixed drinks. And we had about 5,400 licensees who could take advantage of that ability. We also have been involved on the enforcement side with the COVID-based restrictions. We've been working in partnership with the Virginia Department of Health, really all over the state, but certainly in Hampton Roads, where we had the outbreak earlier this year, where we've been a partner in 97 inspections, where we will work with VDH to go into the licensed establishment, make sure they're complying with distancing rules, educating them on what they need to do. And then in 9 of those cases, the health permit was suspended. So we weren't necessarily there enforcing our licenses, although we certainly took action if we saw something. We were really there to lend our support to VDH and give them the experience that we have with our agents in working with the licensing community, and have found that to be a great benefit. We also were given a new regulatory responsibility this year in games of skill. Madam Chair, I think your bill was in the Senate impacting these games. We were given the responsibility for creating a regulatory program to register and track movements and then inspect the games of skill. That legislation was passed during the veto session, and we had to be up and running by the end of June. We were able to do that. I give great commendation to our Bureau of Enforcement in putting together that regulatory program and working with the stakeholders. Department of Taxation is responsible for the tax collections, and we worked closely with them to make sure that we had our bases covered for this 1-year implementation of games of skill. What we have so far, we've got 87 distributors registered for a total of 10,291 machines. That is the cap that can be in Virginia. That was part of the legislation that machines had to be registered by June 30th in order to be legal to play for the next year. So that is the most machines that you will see in the Commonwealth. From the Department of Taxation, the first month of tax payments accounted for a little over $12 million for about 10,000 of those machines. Most recently, in the second month of this program, we've got 9,331 machines in play. The reason that's different than that 10,291 number is the distributors do have the ability to warehouse a machine. They would do that in instances where they're looking for a location that they think would be a benefit for them to have a machine for play. Also, with the uncertainty around operating a restaurant at this time, some restaurants continue to be closed, and so they didn't want a machine necessarily sitting in a closed restaurant or potentially one that has reduced capacity. So that's where you'll see that reduced number in play. Just as a reminder, these machines can be in ABC retail establishments. They can also be in truck stops in the Commonwealth. So as part of the report, distributors have to report what was wagered in the Commonwealth, a little over $176 million, and they reported $135 million in prize winnings during that time. This is just a breakdown on where the games are in the Commonwealth, broken down by enforcement region. So you can kind of see where the wagers are taking place and where the machines are located. For the retail stores, our COVID-19 response has been very similar to other retailers. We've enhanced our cleaning. We've made modifications to our stores. We've even contracted for deep cleaning in cases where we might have symptoms in the store or there's a confirmed case. We did make masks mandatory for our employees and our customers. We have allowed our employees to call out if they don't feel safe working, especially at the beginning when we were still trying to make these safety improvements. We enhanced pay for our employees in the stores opening at noon, closing earlier as well at 7. We have since extended our evening hours back to normal closing times. We've also increased our hiring during this time to really backstop the employees who decided to call out, who did not want to work, but then also just the added man hours that we needed to operate with the additional restrictions that we were seeing and just additional work roles that folks had, from enhanced cleaning to being a greeter at the front of a store in order to make sure that folks were wearing masks when they entered. During this time, we've also very much focused on e-commerce. In the span of about 2 months, we were able to set up e-commerce for curbside service so that you can order on the website and designated time within 4 hours. The earliest you could pick up is 4 hours after your order, but you can designate a time over the next 2 days to pick up that order. It's completely touchless. You pull up, we put the product in your trunk, and you can pull away. Of course, we ID and check for intoxication and those sorts of things as well. We also stood up a home shipping effort down in Suffolk. This is a pilot effort on overnight delivery that we're looking to expand in other parts of the state this fall. Again, trying to provide greater options around the e-commerce space rather than having to come into the brick and mortar stores. This just gives you a sense of some of the costs of actions we've taken, from enhanced cleaning protocols within our stores. We did have to engage in some emergency purchase of supplies for cleaning efforts. Secretary Lane spoke about those first few months of trying to get PPE, trying to get cleaning supplies. We were very much deep in that. We, as I mentioned, reduced our operating hours due to staffing shortages, as well as making sure that we were had the right safety around social distancing. We implemented counter stores, which was kind of a throwback to another time at Virginia ABC, but we found it was a way to minimize customers circulating through our stores. They were able to designate the product they wanted. Our employee would go get it and take it to the counter where they could check out. And then also noting there that the service commitment pay, as well as the installation of plexiglass in our stores to protect our cashiers at the register. Our warehouse, we also did an incentive program for the warehouse to keep folks working and compensate them for the work they were doing. Again, we implemented social distancing, which impacted our efficiency, no doubt about that. But it was the right thing to do from a safety standpoint. We ended up needing to hire additional folks in order to cover those additional needs. We shifted how we work in our warehouse to allow for greater social distancing. So you had 4 10-hour days as opposed to the 5 8-hour days, and we could adjust accordingly. We do daily cleaning in our warehouse. We also do a deep cleaning every Saturday to make sure the warehouse can remain up and running. And we also have provided lunch for our employees really since the start of this to make sure that they don't have to go out and be further exposed in the public, but it also supports our local restaurants. Shipping volumes continue to be very high right now. We are seeing holiday-like numbers over the course of the pandemic. May was the 7th largest shipping day in FY20, which is not common. Typically, that is in the holiday season. One call out is supply chain. Secretary Lane again talked about that with other things. Our supply chain, we are seeing greater out of stocks in our warehouse. We're seeing things that are coming imported are certainly impacted. Tequila and brandy being the most, but seeing customers shifting to larger size bottles. We're seeing glass and inventory shortages. So this is something we are watching very closely as we go into the holiday season, which is typically our busier season, and when out of stocks traditionally increase anyway. You'll see that in the blue line, which is the 2019, but we are certainly far exceeding the out of stocks for this time of year. And that's really just around making sure our suppliers can get us the product that we need. One of the key indicators for retail stores is the percentage of in stock, because you can't sell something that's not in the store. And what you'll see here in red is our current in stock or out of stock for our stores, which is trending. We really like to be above 97%. You saw we were able to do that in 2019. We are more challenged now in 2020 with our out of stocks. And again, that's about supply and getting product from our suppliers as they deal with their own challenges around plant closings, glass shortages, and just general friction in the importation market. So the FY20 results, we had a tremendous year. This is reflective really across the country of what both control states and open states have seen in the alcohol business. We did about $1.2 billion last year, which is up 11.3% in gross sales. Our profits were up about 7%. Our licensee numbers were up a little bit, not as much as in years past, and we would project probably seeing that come down. On the other side of that ledger, operating expense has also gone up tremendously. Again, that comes from the increased cleaning protocols, higher pay for our employees during this time, and just having to account for the safety of employees, spending on PPE, other things like that. We did get about $1.7 million in care reimbursement funding for our PPE and other items, but certainly seeing those expenses increase in this environment. This is just a slide that shows historic profit growth. We continue to grow our stores, continue to grow profits for the Commonwealth. And this is a slide on the last 7 years. We've contributed over $3.2 billion from profit transfers as well as tax transfers. What I would say, this slide also indicates, if you look at that FY20 column, all categories, malt, beverage, wine, and spirits are all increasing this year. which is actually breaking a trend for malt beverage tax that had been decreasing in years previous. So just overall, we are seeing greater purchases of alcohol during this pandemic. This is just to try to capture one of the things we're looking at is how to forecast FY21. And so this just gives the last 6 years. Generally, we're pretty comfortable forecasting somewhere in that 4.5% to 5% growth year over year. That's what we've built our Gaker forecast in the past. FY19 was a strong year for us. I think it was a time when we were, it was a beneficial time around holidays. It was a week longer in the holiday. It also included some additional promotions that we did. So that was a good year. We were trending about that way in FY20. And then the pandemic hit March, April, May, June, and we really saw our numbers jump to that 11.3%. To use a term that Secretary Lane used around non-withholding, it's trying to figure out what the collar should be on this. I certainly don't think that we're going to continue to grow in the next year at that 11, 12, 13% rate. I don't think there's anything out there that contributes to that so much as folks' reaction to the pandemic. And so trying to figure out what a full year might look like is certainly a challenge to us as we continue to look, especially around things like if the recession continues, folks' spending becomes more constrained, or if the supply chain continues to become tighter as well. A couple informative charts to kind of help give you all a picture of what our business looks like right now. We continue to see increased month profits and sales in the new fiscal year. Again, I think it's largely attributable to the response to COVID, but also looking at what are the limitations around unemployment, changing consumer patterns, licensee closures, that sort of thing. But the numbers are certainly telling. March of 20, when this really kicked up, was the highest month we had seen, except for December, which is really November, December, our biggest month. So it was really equivalent to holiday shopping. Here you'll see kind of the sales growth that we've seen and how things have shifted around. The holiday, again, you see that spike in December, but really you had even a higher spike in March due to the initial closures. I think there was some buying that occurred, especially when Pennsylvania closed their liquor stores. I think folks were worried Virginia was going to do the same, and so there was certainly some buying around that and making sure that folks had product. Really trying to figure out what the holiday will look like. Senator Marsden, you referenced limitation on gatherings, which is a typical signature event around holidays, and the spirits involved in that. I think that we're probably going to see a pretty strong holiday season for us, but again, trying to figure it out. There's a lot of uncertainty in that picture. Certainly our licensees have been dramatically impacted by the COVID pandemic. What you see here is the drop of sales really to zero to our licensees. Generally, they're 16 to 18% of our revenues. They dropped to zero towards the end of March, beginning of April. You see that uptick when we were allowed to do cocktails to go, as well as the phased opening. But we're still about $1 million below what we would normally see in licensee business for this time of year. So they continue to come back, but it's going to be a slow process, and likely not until they fully open up can we do that. Can we see the purchase levels they had previously? Online orders. I talked about our focus on e-commerce. We are seeing folks shift more to an e-commerce platform, and you can see that the Cyber Monday spike in 2019, but again, the spike that you're seeing during the pandemic, the two dips you see there are because we didn't do two online promotions of Cyber Mom Day and Cyber Dad Day. But overall, we are seeing a lot of adoption of e-commerce, a doubling of the volume that we would see in a typical year. So we're seeing consumers very much take advantage of the opportunity to not necessarily have to come into a store to shop, but have the inventory of a store accessible to them through e-commerce. That being said, e-commerce remains a small portion of our sales. It's still, about 1%, but it's, I think, a growing aspect. And certainly as we become more accessible to our consumers through curbside pickup and overnight shipping, I think we'll continue to see our customers avail themselves of this opportunity. And we think it's something that will make us more resilient come the fall if there is any spike or concerns, that we're going to be able to continue to remain open and serve customers in a safe and efficient manner. So I know that was a quick run through, but really just all of the success we saw this year was attributable to our employees and the dedication that they had in working through some pretty stressful times, and certainly want to give them a word of thanks in my closing. So thank you, Madam Chair.
Thank you, Travis. Well, I'd like to give you a thank you as well, because you were working through the same pandemic. Are there any questions?
Yes, Chair. Adam Evan.
Senator Evan.
Yeah, Travis, thanks for the thorough presentation. One thing that caught my attention was you mentioned that you all had done assisted VDH with 97 inspections. And I had a few questions about that. I was wondering if they were complaint driven or if they were random.
A little bit of both. If we or VDH received a complaint from a patron or someone in the community, we would put that on a list to visit. We would work with VDH. VDH would identify what areas or locations they wanted to visit. And so very much complaint driven, but we would also just work with VDH to identify locations they thought would be worthwhile to visit.
And if I could follow up, Madam Chair, to ask, the 9 suspensions you mentioned, how long were they for?
VDH would have more definite information on that. My understanding is VDH will take that license and then allow the licensee to come back into compliance with whatever they were violating. And then at that point, they would have the health permit returned to them.
Well, thanks for your work with that. I think it's really important that you work with them. So appreciate you doing that on top of all the other things we have to deal with during the pandemic.
Yes, sir. It's been a great partnership. I think we were able to use our experience working with licensees in enforcement capacity and supporting VDH and the important work they were doing. So we were glad to do it.
Madam Chair.
Senator Peterson.
Travis, first of all, thank you for your excellent report. And I guess my question is, and I'll just say parenthetically or autobiographically, I represent a lot of restaurants, and obviously they've been just crushed by the last 6 months. And of course, your agency, more than any other agency in the Commonwealth, is on the front lines working as a supplier with restaurants. What can we do? What can your agency do? What can we as an assembly do to help out restaurants that would normally relying on alcohol sales as a way to get people in the door? You talked about the ABC off premises and ramping that up, doing curbside. I mean, what can we do though to help private businesses stay alive and hopefully do better in 2021?
Great question. I think what this pandemic has done is really reframed the conversation around these businesses and control of alcohol. And I think there are probably some opportunities to look at changes in the law on what we can do. When we adjusted our guidance, we kind of told ourselves we got to be able to live with this long term in case it does become a permanent basis. So I think things around looking at how we allow service with the licenses, I think is important. And really what we've done is listen to the call outs they've had. I mean, just recently we talked about making sure that we remind licensees that if they've got reduced seating capacity with license renewal, they need to tell us that, because that could impact their license fee, and we can adjust that seating capacity accordingly. So it's really what we're trying to do is continue to communicate with our licensees and see what they're experiencing on the ground. Because really, we don't have that experience, and so keeping those lines of communication open are important to us so that we understand where they're seeing things and how we can adjust accordingly in that regard. So,
and
I think
go ahead.
I think the other thing, you all handled legislation for Senator McPike around allowing, I guess, greater ability for community licensing in open areas outside. I think doing things like that in a controlled manner, because we're in this space where generally in alcohol licensing, there's this designated premises and you're limited to that premises. And now we're telling folks you can't have as many people in that premises. And then you also have people not wanting to go in. And so figuring out how to be more flexible to allowing those events to occur, but making sure that we put the parameters around it so that we don't lose the public safety aspect, I think is important.
Right. And I was just going to add, for the last 6 months, we haven't had bar seating at restaurants, which obviously, for my clients, that's not just the revenue. It's also a chance. It's how you greet the public and how you get people interested in your dining room. And that's had an enormous impact. And again, I know you're not VDH, but if there's any way that we can sort of find a medium where, again, we can get people inside our restaurants, get them inside our dining rooms in a safe way, your advice and your counsel would be helpful on that.
Glad to be a partner in that.
Senator Norman.
Travis, first of all, I want to compliment you not so much on your presentation, but your masculinity that is being shown by the growth on your face on it. But secondly, going back to a favorite subject of Senator Howell and myself, and that is the gray machines. And remind me, are we relying upon an honor system to report revenues?
Yes, we've got a reporting system that the distributors report to ABC where their games of play are located. There is I cannot remember off the top of my head, there is a steep penalty for failure to report these games. And we do have agents that are going out and making sure that we have games that are properly licensed. As part of the registration process, we issue them stickers, fairly large stickers that have to be stuck on the side of the machine that our agents are able to look for. If a machine does not have that sticker, it is an illegal game, and there are penalties for that. But these reports are certainly compiled and prepared by the distributors and sent to us, so we are dependent on them to be forthcoming in how they report.
Madam Chairman.
Yeah, Senator Norman.
I appreciated that has a sticker on the side which indicates, that it's appropriately licensed. But what do you do to validate that they are reporting the accurate numbers? And I don't mean to be disingenuous, but I have historically referred to them as somewhat as bandits, and sometimes bandits are less than forthcoming with information.
Well, certainly, we're going to look at when their reports around games to make sure they've got the right number of games in the report versus what they've got registered with the state. I think as this goes on, we're going to need to work with taxation to see what taxes are being collected for these various distributors, and probably walk that back to look at what machines are registered to kind of ground truth that, if you will, to make sure that there's not something going on there with those numbers. We have certainly seen we field a lot of questions, and it's new to us. And so as we get in these first few months, I think it's going to be important to get out there and see what's there and continue to talk to tax to make sure that we've got our bases covered.
Madam Chairman, I noticed from your facial expressions that you were dancing around that just a little bit. Have you come across any bad actors who have been less than forthcoming with the information?
We have not had any enforcement cases to my knowledge. We've had a couple complaints that we're looking at now. Part of that is I think the first reports we received were towards the end of August. So we're still in the very early stages of kind of clearing the fog of what people said they were going to do and really getting the numbers to say, okay, this is what they've done. And so I think it's again, incumbent on us as we start to see these reports come in. I think tax had their first revenue numbers they provided to us last week based on those reports. So we're really in the very first stages of getting hard, fast numbers on that. And so we need to begin that process of looking at them.
Madam Chair, my last question in that regard. Are you innovatively looking at any potential system that could have a central collection agency, and I'm talking about data, that would validate the numbers?
Validate when you say validate the numbers, or Senator, are you saying
That they're accurate.
the number of games or
The money?
The money. We have not, because tax is the one that collects this revenue. I can take your question back to see what tax is doing and what we can do to validate those numbers.
Thank you, Madam Chairman.
Yes, I would just like to add that Senator Norman, Governor Northam, and I remain united in this is going to end at the end of next June, so that nobody is doubtful.
Yes, ma'am.
Okay, thank you. And thank you for all the work you're doing on it, Travis.
It's been an education, Madam Chair.
I'm sure it has. And dealing with bandits is always interesting.
Hey, careful how you describe people like us.
This is the end of the formal agenda, but a couple of days ago, I was sort of thinking how fortunate my husband and I are, and most Virginians are, that we actually have medical insurance during a pandemic of this magnitude. And it raised the question for me, how many people have benefited from Medicaid expansion? So I've asked Mike Tweedy to give us a very brief update on what's going on with expansion.
Thank you, Madam Chair. It's Mike Tweedy. So just very quickly, I did prepare a one-pager for the chair, which if you like, I could send this to the committee after the meeting. It quickly summarizes the enrollment and the spending. So as you know, Medicaid expansion has been in effect now for 21 months in Virginia. For the first 12 months, enrollment lagged the projection a little bit. But basically since January, it's actually kind of exceeded our projection. And as of September 1st, it's reached just over 458,000 Virginians enrolled. And it's kind of exceeded the projection for two reasons. Back in December, when we had open enrollment for the federal exchange, more individuals enrolled, switched from exchange coverage to Medicaid than was expected. So there was a little bump up there. And then of course, since April, with the Families First Coronavirus Relief Act, the enhanced federal match that all states receive, we have to agree to maintain eligibility during the public health emergency under the idea that people should not lose healthcare coverage, as the chair mentioned, during the emergency. So you don't see the normal number of people disenrolling each month. So you see that enrollment increases, and that's why it's past 458,000 on September 1. On the spending side, just a quick summary in FY20, just the magnitude of spending and expansion. The state spent almost $3.2 billion, of which over 2.9 billion were federal funds that the state drew down to pay for it. And as you know, the remaining state share of $275 million was paid for by the hospital provider assessment. And I would just note that DMAS has two dashboards that they maintain twice a month. They update with both enrollment data as well as how individuals on expansion access healthcare services. So it has information like the fact that over 37,000 have been treated with diabetes, over 8,700 with cancer and things of that nature. And I can send the committee those links if you would like to look at it, because it also includes maps where you can actually see the data to the locality level. So with that, Madam Chair, unless there are any questions, I can send that information to the committee.
Great, thank you, Mike. Are there questions?
Madam Chairman.
Yes, Senator Norman.
Thank you, ma'am. Mike, how are we doing with the hospital providers? How heavily have we hammered them?
Madam Chair, Senator Norman, like I said, so for fiscal year 20, which was the first full year, pretty much the assessment was about 275 million. That was, I think it was about 17 million less than expected because expenditures were slightly below what we had expected. And that's just because the population is just, cost a little bit less. For 21, it should grow. It'll probably exceed 300 million, but I can get you the exact numbers if you want. But it's virtually fully implemented now. So they're going to be paying to the tune of 300 to 400 million per year. Madam Chairman, as you know, this is not an area that I delve in, and makes Mike very happy that I stay out of it. But having said that, I think if I recall back during our discussion about Medicaid expansion and the hospitals were persuaded to make a provider contribution, that there was an expectation, or at least a projection, that they would be able to recover that money over a period of time based upon reimbursements. Do we have any tracking of that? Madam Chair, Senator Norman, certainly, yeah, I mean, we know how much they're paying in. I can check with DMED. Yes, there has been a point where they have been tracking that. I don't know how up to date it is, but I can check into it and get that information to you. The only issue will be that right now, the pandemic has disrupted, of course, as you well know, hospital reimbursements when they ended elective surgeries and things like that. So with that hiccup, I can certainly get you the latest information.
Thank you, Madam Chairman.
Yes. Any other questions? Is there any further business to come before the committee? Okay, well, let's all hit the road and get down to Richmond. We're adjourned.